All right, folks, welcome back. The key theme to today's show is this pendulum potentially swinging back toward the names that hadn't done well. In fact, toward a lot of the laggards. In fact, my next guest has some ideas that he thinks could be attractive at these prices. I want to bring in Matrix Asset Advisors President and CIO David Katz. And David, I will point out, I know you were bullish. Your firm was bullish for most of the first half of the year, but you see that pendulum moving and you want to start to get positioned for it, right?
Yeah, we think stocks have done great. We think the second half of the year is going to be a lot more volatile. We think some of the things that led in the first half are going to slow down. Some of the things that were really particularly poor in the first half are poised to do a whole lot better. So you want to buy in front of those. You want to take advantage of days like today, not chase the up semiconductors, but buy things like consumer staples, which are just getting hammered today. And we think if you have that 6 to 12 month time horizon, you're getting really good prices.
All right, let's start with the one right here. You know, this STZ, let's bring STZ back. You've got three of them. We'll start with this. Listen, hot stock, I remember playing it a few years ago. It was going to also be involved in marijuana and all this sort of stuff. What about the fundamentals, though? People are drinking less and those kind of things. Does that bother you? Or do you think at this point is all that kind of stuff is already priced in?
It's priced in. So there definitely are trends away from alcohol industry and from the beer industry. Younger people are definitely drinking a lot less. However, in terms of Constellation Brands, and you see from the chart, stock is down about 35 or 40% over the last few years. They're still making a great deal of money. They reported earnings in the last week or two. Earnings were in line to a little bit better than expected. The outlook was okay, but the stock's at 11.5 times earnings and pays about a 3.5% dividend yield. They're gaining market share in all of their critical markets. It's a very well-run company, and you're getting it at a very attractive price. We think at some point the pendulum does swing back to beer sales.
Right.
They're probably being helped a lot with the soccer right now, helping demand there.
Yeah, no, I think you're probably right there. Hey, let's talk about Nike. Again, this is a name they reported. Initially, the stock was up in the aftermarket. You come the next day, it's down, and it's just sort of meandering there. What does it need? What's the jolt that's missing there?
Well, they just have to show that they are going to be a force on a long-term basis and they've turned the corner. We definitely think they're bottoming out. They probably need a quarter or two to say that they've actually turned the corner. Certain parts of U.S. sales are getting better. They've reestablished relationships with some of the retailers that sell their product. Yet the stock is at a very inexpensive valuation on normalized earnings, pays a good dividend. There was a good deal of insider buying last quarter at higher levels.
Right.
So we think, again, if you take a longer term view, you're getting a really great global franchise at a very attractive price. And we do think they have turned the business around. It's just going to take a quarter or two to show that progress.
Utilities, really at one point they were in a sweet spot. It was a traditional safe haven, but also an AI adjacent play. Recently, they've kind of pulled back here a little bit. Next era, by the way, it was the best stock to own during the Obama era because of all the money that was being pushed into solar. It's a great looking chart here. I guess my question is, why have they, in my opinion, they've sort of underperformed. I don't know if you utilities that just haven't done as well as I thought they would have so far.
Utilities had a great 4 or 5 months and then gave it back over the last month or two. So we would use that as a pause that refreshes and would buy. Nextera announced a large acquisition of Dominion, which puts a little bit of a ceiling on the stock price for a little bit. We think it's going to be a really good deal. It's very accretive to earnings. It increases their long-term earnings growth rate. You're getting a good yield. And the whole thing with AI is you need power. Companies like AEP and Nextera are the best position to provide that power. So their long-term earnings growth are going higher and you're getting them at okay valuations. This is one that we think you can buy on this dip. We think you easily have 10% on the upside.
Yeah, and we have to add the dividends on these utilities are, a lot of times people say you get paid to hold. You really do get paid to put them on the shelf. All right, I got about a minute to go. I want to talk about some of the tech names that have been laggards that you think could be a buy here. Amazon, Meta, Microsoft. Microsoft down a few points today. Again, it's just, I can't, I'm in Meta, down huge on that one. I just wonder what's the spark going to be. It feels like when they finish spending all the money they've got to spend over the next couple of years, maybe that's when they slingshot back, but you like them here.
We think the pendulum's going to swing back toward the stocks a lot sooner than that. If you look at these players, they've all made very smart investments over the long term, especially companies like Microsoft and Amazon. We're highly confident that the money they're putting to work is going to be money well spent. You're getting the cheapest valuations that you've gotten them in a long time at 18 to 22 times earnings. Great long-term prospects. We think the catalyst is going to be when all of a sudden the semiconductor stocks start to slow down and that money migrates to somewhere else in technology. It's going to migrate to these tech stocks. We think all three are at great prices, very good long-term prospects. We're very comfortable that the money that they're spending is going to be money well spent. Meta is the cheapest of the group. There are more questions about their spending, but we think they're going to be able to monetize it in better advertising and a better customer experience for Facebook and for Instagram.
Yeah, I agree with everything you said. Maybe our timing is different, but I do think that these investments, these folks sitting on the 30th floor of some Wall Street firm downtown, they can criticize these guys all they want, but I got a feeling they know what they're doing, and they're looking beyond just return on investment for the next year. David, great stuff. Thank you very much.
Thanks a lot. Thanks for having me.
All right, see you.